Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady. I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to be hearing about topics that are important to the home business community. And today we're talking about tax code, the new tax code, and cryptocurrency. So let me give you a little bit of history to bring you where we are now. So first of all, cryptocurrency in the United States is not actually legal tender. Although people accept cryptocurrency payments, I accept cryptocurrency payments. But it's really not legal tender in the United States. Legal tender in the United States is the US dollar. There is only one legal tender at a time. However, that does not mean that cryptocurrency is fake money, okay? It is treated as property in the United States. And so with that, transactions are taxable. Buying cryptocurrency is not taxable, but when you sell your cryptocurrency either to buy products, services, or even other cryptocurrency, those things are taxable. And how did that happen? Well, with the new tax code that was actually passed December 22nd, 2017, one little word took away that like-kind exchange when you don't have to pay capital gains tax on cryptocurrency for cryptocurrency. That one little word is real. And the reason it is that with a 1031 exchange, okay, originally the tax law said property, okay? When they redid that with the tax reform and added real property, then that was restricted to real estate. So 1031 exchanges are restricted to real estate only. That is land, that's apartment buildings, okay? Real estate. So, at one point, people were doing it with cars and all of that. But with cryptocurrency is really treated like stock. If you start to think of it like stock, then you'll have a better idea of how it works as far as tax is concerned. Because even with stock, if you buy, if you have some stock in AT&T and you want to buy stock in, let's say, Sprint, okay, well, you can sell your, you have to sell your stock with AT&T, and if you have any capital gains there, you have to pay that, and then you buy your stock with Sprint. That's really what the process that happens, even though it really seems like a really seamless transaction. That's the process of how that happens. And so when you have capital gains, then yeah, that is a taxable event. It's taxable. Now, if you have losses, then you report the losses as well. All right. Now, understanding the difference between long-term capital gains and short-term capital gains. Long-term capital gains happen when you've held your property, hence cryptocurrency, for more than a year. Anything less than a year, you're going to pay normal income tax rate. That's the short-term capital gain. Short-term capital gain is really income tax rate. So whatever your income tax rate is, that's what you're going to pay. And of course, that fluctuates based on how much money you make. The more money you make, the more taxes you're going to pay, right? More, as the tax brackets go. So, with your cryptocurrency, if you hold your cryptocurrency for more than a year, then you pay capital gains rate. The top capital gains rate is 20%, and only the really super wealthy people are paying the 20%. So you might be paying 0 or 15% on the capital gains if you hold it for less than a year. So the only thing that tax reform really had an impact on is being able to avoid capital gains by exchanging cryptocurrency for cryptocurrency. Because see, before tax reform, they really didn't say that, but understanding that the cryptocurrency is being treated like stock, it applies the same way. So there are some people that took a position, well, this is a like kind exchange. And that's why in a previous video I did about capital gains, I said you might be able to get away with that through 2017, but after, January 1st, 2018, not gonna happen, okay? So you have to start treating those things, those trades, as their taxable events. And so that means you have to track them all. And I know it's a difficult thing, because, just looking at the last year of cryptocurrency. If you were on social media, you saw people talking about, woohoo, I went and bought a car, I went and bought some coffee, I went and bought a sandwich with my cryptocurrency. And then once people really started figuring out that all of those transactions had to be tracked, all of that willy-nilly buying has stopped, or at least they're not posting about it anymore, okay? Because the case with Coinbase really brought the taxation to the forefront. Really, people, were really under the impression that buying and selling cryptocurrency was going to remain an anonymous thing. But when the IRS sued Coinbase, and the IRS won, okay? They won and got access to all the customer data. Then that's when everybody pumped the brakes and wanted to find out really about the taxation, because people were under the impression that that there was no taxation involved with cryptocurrency. But once the IRS won that case, they're starting with people that had over $20,000 in transactions. So, and so people are like, okay, well, that's just those people. Listen, that's where the IRS is going to start. That is not where they're going to stay. When they start to really build the technology that's going to catch up to this stuff, then that's when you get found out. And so, understanding that if by not reporting your gains, that is tax evasion, it's fraud. There is no statute of limitations on that. You got to understand that. So if they figure out in 2025 that in 2018 you had gains on cryptocurrency that you did not report, well, it doesn't matter. They can come back all the way till now and figure out what you owe and then add penalties and interest, and you're going to pay. All right. So, so the main thing that I want you to take away from this is just understanding with your cryptocurrency, you've got to track your transactions. There's lots of tools out there now that are available for tracking transactions. If you're trading, like it's your job, then you're going to be more than likely paying income tax rates because you're not buying and holding. People who buy and hold cryptocurrency, if you hold it for more than a year, then you're going to have the lower capital gains rate. But there are some people that are constantly trading, and I don't know how that whole trading thing works. I just know they buy and sell and do it on a massive scale, right? So that produces a lot of transactions, and you have to track all of those things. So depending on where you are with cryptocurrency, buying and holding for a year, you're going to have the long-term capital gains. If you're trading constantly, then, if you're holding Bitcoin for, or whatever, Bitcoin, Ethereum, Ripple, whatever, if you're holding it for less than a year, then you're going to be paying income tax rates on your gains. And the other thing is that cryptocurrency is cryptocurrency. You might have Bitcoin, Ripple, Ethereum, Litecoin, altcoin, whatever. It's all cryptocurrency and it's all treated the same. It's not like the tax laws that apply to Bitcoin don't apply to Ethereum. That is not how the US government works. I don't care what kind of cryptocurrency it is treated the same, it is taxed the same, and I don't care, like how many transactions you got to go through to get your money back to whatever fiat currency. Like one of the questions that I got was, if they purchase this, I think it was altcoin, and then they have to trade it to exchange it to Bitcoin in order to exchange it to cash. Like, well, yeah, whatever gains you had on altcoin, that's taxable. And if you trade it to Bitcoin and you hold it and you get some gains there, that's taxable. So you have to really understand that you've got to track those transactions and you have to track your gains. And the gains and losses offset each other as well. If you have a long-term capital gain and a long-term capital loss, then those offset each other. If you have a short-term capital gain and a short-term capital loss, those offset each other. Long and short-term do not offset each other, okay? Just so you know. All right? So that's really the impact of tax reform. It's just that they restricted 1031 exchange to real estate only. So it no longer applies to vehicles, exchanging vehicles. It doesn't apply to any other type of property except real estate, real property, all right? Land, buildings, that kind of thing. All right, that's the restriction. And so that's really it. I have my Bitcoin tax guide available. I have to update it because I'm going to be adding some more of the current stuff to actually cover this topic as well. So be looking for that in the near future. But yeah, the main thing you want to do is definitely track your gains going into tax season. You want to make sure that the tax professional that you're dealing with understands cryptocurrency, and so that, so they can really properly prepare your return, because not everybody is studying cryptocurrency. Okay. And, a good tax professional will tell you whether or not they get it. But, a lot of people just don't get it. Going to the tax franchises, you really better be asking if the people understand cryptocurrency, because 9 times out of 10, they probably have not. Okay. All right, so that's it for me, you guys. Thank you so much for tuning in to today's episode of Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come here and get the questions answered you have about your home business. All right, have a great day, and I'll see y'all next time. Bye.